Welcome to TheoTrade. This is Don Kaufman. It's February 23rd, 2024. Just about 40 minutes to go to the cash close here on this Friday afternoon. Things kind of dying down a little bit. Obviously, after the fever pitch, everybody's talking about it. It has become a one stock market. That and much more here, of course, on this TheoTrade weekend update. Well, let's get right to work here, taking a look at the S&Ps on this Friday afternoon. As I said, things have largely kind of died down. The S&Ps rallied quite a bit earlier in the day, fading a little bit. Right now, we're drifting just north of the massively unchanged line here. SPOO's up some 5 handles, but, well, if you missed most of this week, yeah, there's really only one thing to talk about, and it's Nvidia. I'm going to discuss Nvidia in what I term the one stock market, in the sense of looking at this of what's really driving the trade, which I've talked about extensively in the past. When I say driving the trade, rather than just talk about market makers, well, we're just going to go for it today, right? We're going to actually talk a little bit about the dispersion trade that is really kind of the driving force behind some of the moves that you're seeing in stocks like Nvidia and stocks like Meta. Before I get there, a little bit of an update, and then, of course, for those of you that are interested, I'll also discuss a bit about catapults, which is a play, if you will, on the dispersion trade. In effect, what I'm saying is, if you want to, do your own dispersion style trade, like many proprietary trading firms and hedge funds and market makers are doing, I'll actually give you, ability to be able to do just that. Let's go down to business here on this weekend update. As I was saying a moment ago, SPOOs, for the most part, are massively unchanged. But one of the first things I want to talk about is S&P 500. What I term is diversification has been severely compromised. Now, look, this has been going on a long time, right? There's the Magnificent Seven. Nothing mattered but the Magnificent Seven. But now we're basically like, okay, nothing matters but Nvidia. Nvidia rallied the entire marketplace throughout the week, and really capped it and iced it off with, an extensive move, of course, following the earnings announcement. Again, we can go into incredible depth about that, but look, it's passe. We're actually going to talk about the trade that actually drives that, because one of the questions that people constantly ask is, who would be crazy enough to buy a stock when it looks like this? I mean, it's fairly parabolic. And a lot of, I think, retail traders and people that hop on CNBC and, look, I've done a lot of that in the past. They hop on CNBC and so forth, and look, they're basically whispering in your ear what you're talking about and so forth. But that's usually just, hey, look, we're buying this, we're selling this, and okay, but that's not actually the trade that literally drives some of the moves. And that's the aspect that I'm actually going to focus on here, well, momentarily. One of the first things, though, as I was saying, is, S&P 500 diversification is now severely compromised. And it has everything to do with, of course, the market capitalization and the structure of the S&P 500. Nvidia at this point, and let's talk, and I've talked extensively about this in the past, though. Nvidia at this point is basically a $2 trillion company. You're like, who cares? Microsoft's bigger. I agree. Okay, I agree wholeheartedly. Microsoft's a $3 trillion company, right? Apple's right there neck and neck with it, 2.8 trillion. You believe that? But when I talk about being severely compromised in terms of diversification, so what do you really have, right? You got a $3 trillion company, another $3 trillion company. You're like, what? Nvidia is the third biggest stock. Nvidia is the third biggest stock with a $2 trillion market cap. But as I always try to express to people, okay, you got to go deeper than market cap. I just want you to go out approximately some 30 days. Now, look, we're through earnings. I don't have to worry about earnings anymore. And the implied volatility is roughly 50%. So it's 50% implied volatility. Now compare that to something like Microsoft. It's okay, go for it. It's about 20%. So what do you have? You have volatility that's, double, 2.5 times. I'm just estimating. So when you think about, volatility, and volatility plays a significant role in moving markets, right? So something that's a 50 vol compared to something that's a 20 vol, right? You don't risk the same amount of capital because you're getting what? 2 times plus the movement in something like Nvidia. The bottom line is if you were to look at market capitalization, 2 trillion versus a $3 trillion company, but the $2 trillion company, which is of course Nvidia, is significantly more volatile. It's by far and away the biggest monkey on the block. And we're starting to get to this point where, and we've probably crossed through this threshold, some time ago. Can you imagine the impact that a $200 or $300 move on this underlying, okay, and how devastating that could actually be upon the S&P? But moreover, it's not likely that something like Nvidia would just have some autonomous move. And this is where, people, they're constantly comparing this to, like, I remember back in the day, okay, of what? The internet boom and and oh yeah, it's completely different. And I keep reiterating that. Yeah, it rhymes a little bit, but it's never different, but it's completely different because we're concentrating the market capitalization at this point. Whereas, back in the late 90s, early 2000s, when the market obviously tanked and NASDAQ peaked and tanked, there was a very broad spectrum of stocks that had investments in them. This is something very different. And the concentration right now, when I say concentration, I mean the way you got to think, okay, of what's going on right now. And I'm going to actually box this in a little bit. I'm just going to freeze the screen and box it in. Okay. Trading firms right now are concentrating all their firepower, okay, into basically the Magnificent Seven. And you know what? Even Tesla is kind of like the odd stock out. I'm almost highlighting it out because I want you to see that, right? So what do you have? You have some Microsoft, a little bit of Apple, Amazon, definitely some firepower in there. Maybe Google, absolutely unequivocally Meta, and of course Nvidia. And Nvidia is the big one in there. And when I say concentrating firepower, okay, they're concentrating all of their option firepower in there. And options, okay, are now the cart leading the horse. So in Nvidia, you basically have like what, 3 million contracts trading today. Okay, what do you got? Let's get crazy. Let's go over to Microsoft. What do you got in Microsoft? In Microsoft, how many contracts are trading? 300,000, 350,000. So when I say that they're like concentrating firepower, like I'm not kidding. So what kind of a trade is really going on? So again, I think most people understand that the risk of diversification in the spiders and the S&P 500 is largely lost. I think that's an easy concept. The hard concept is dispersion trade is largely responsible for the moves. Okay, let me explain in very, very common terms, okay, the way that a dispersion trade can work. Now, there's a lot of different types. It's a very large genre of trade, but the easiest way to kind of explain it is something as simple as this. Look, okay, we could go out, all right, and we can sell boatloads. Let's actually, you know what? Let's go to the mother of all products. Let's go right into the SPX. We can go out and we can sell boatloads of options inside of the SPX. Look, for argument's sake right now, when I say we're selling options in the SPX, I don't even care what you sell. People are like, oh, is it 0 DTE? Sure, knock yourself out. You can call it 0 DTE, 3-day, 4-day, 5-day, 6-day, 7-day. Let's get crazy. So you're selling boatloads of options in the S&Ps, and you go, well, what are you doing to hedge that? You don't necessarily have to hedge it. Okay, so what's your risk? Let's say in this example that you're selling boatloads of calls. Okay, and when I say boatloads, I really mean boatloads of calls. So you're selling tons of calls inside of something like the SPX. Then you're turning around and using the proceeds of that trade, if you will, to buy calls inside of Nvidia. Okay, that's the most simple and common logic. And we're actually getting into what we term here at TheoTrade catapult trades. Right? But the most common and basic idea over here is, for instance, okay, you're selling options in like SPX, okay, and boatloads of options in SPX to turn around, for instance, okay, and buy options in a product like Nvidia. And you think about that, and again, the simplicity of the context, you go, yeah, but you know what, Don, then your SPX risk is huge. What if we, and again, let's just look right now at calls. Let's not, confuse it. Let's just look at call options, and we're going to look at calls over here too. And you go, yeah, but the Nvidia calls are so much more expensive. Of course, I agree. I totally agree. That's why you have to sell even more of here, okay, and turn around and actually buy even more here. And lo and behold, can this trade sustain itself? Yeah, but Okay, in the easiest context, what starts to happen is you start to skew the option chain a little bit. Okay, and what you'll see is all that call buying. Look, at the money calls are trading for like a 45 vol, and the further you go out of the money, volatility actually goes up. It's crazy. Why? Because the demand is so heavy on the call side inside of something like Nvidia that it actually is causing skew. Right? So some trading firms, instead of just buying straight calls, some trading firms will actually start using spreads. I bet you'll see it if I switch from here from Delta and I go look at like volume and open interest. Okay, not to confuse anything, but this open interest, I'm going to flip back. Okay, over to Delta for a second, but you'll actually see, huge size, and these trading firms are literally trading spreads in some cases. Why? To mitigate some of the expense. The reason they're really trading spreads, though, is the volatility is now favorable to do so because in a spread, they're buying like a 46 vol. Just to give you an example, they'd be buying like a 46 vol, turning around and, selling something at like almost like a 48 or 49 vol. Like, look at this. This is a wide spread. It's a $35 wide spread for, what, $7, $8, debit. You go, oh, that seems kind of expensive. Really? Go out and sell a couple of SPX options to finance that, and you're gold, Jerry, you're gold. And they just continue to perpetuate it, right? But the one thing that you have to understand about stock, people go, well, how does that drive the stock up? That's ridiculous. Well, what drives the stock up is when you buy a call. When you buy a call, market maker sells you the call. When the market maker sells you the call, the market maker has to turn around and buy stock. You go, well, yeah, that's actually what drives the trade. So dispersion, okay, leads to call buying. Call buying leads to stocks actually going higher. So when you're sitting there at home, you're like, and I know that people literally think this to themselves. They go, what idiot would actually buy stock at 788? Like, look, somebody's going to be the high ticket here, right? Okay, but a market making firm may buy the stock there simply because they're actually mitigating exposure, okay, from a dispersion trade that another trading firm is doing. Like, look, in the end, yes, somebody definitely holds the bag of risk, but I'm going to be very forthright in saying, you really want to know who holds the bag of risk? Why do you think I have S&P 500 diversification severely compromised? Why do you think that's in there? Because in the end, a lot of retail, okay, risk never really goes away. Like, somebody's always holding the bag. It just gets passed around. It's like thinking of risk is like thinking of this wild game of musical chairs, okay? And you just got to make sure that you got a chair when the music stops. So with all due respect, whatever risk that you're thinking, oh, I'm not even in Nvidia. Okay, good. You in the S&P 500, you're a buy and hold kind of person. Okay, that's what it comes down to. Now, one other aspect is if you like the idea, okay, of being in trade like Nvidia and you want to get bullish in something like Nvidia, we actually do like a catapult trade where we go out and do the exact same thing. We finance a trade. By the way, we don't sell naked in the SPX because the margin is absolutely phenomenal. But we actually can sell options like S&P options and futures, turn around, buy spreads in something like Nvidia, okay, and you're gold. It's basically, okay, the same logic, okay, with a twist for retail traders because you don't have the margin to handle that. And even if you do have the margin, it's better use of your capital if you actually learn how to do the catapult trade and learn how to do dispersion, correctly. And that was the idea originally behind catapult. It's a dispersion tactic, right? And it's hot right now. It's the trade. The last thing I want to mention about this, with diversification severely compromised, it's obviously because of this dispersion trade. When something stands out, it's dangerous. When something stands out and becomes, a pivotal stock, and you start to think like, look, Nvidia took over the entire market this week. That's why I call it the one stock market. I mean, there's nothing else to call it. The entire week belonged to it. You have to realize that nobody even took the Fed speak into consideration this week. Nobody, and we're going to talk about that in a moment. They didn't even care about the Fed this week. All they cared about was what's going on in Nvidia. Okay, what's going on in Nvidia? Nobody even looked at the fact that the S&P 500 just rallied. Okay, and it is right now. S&P 500 is outside the upper edge of the expected move. Again, like, nobody's too concerned about that. All they're concerned about is, look what Nvidia did. All right, and it's disconcerting because as soon as everybody starts to understand the trade and it's dispersion trade and it's just like this and this is how it works, okay, and I'm sitting here mentioning that how dangerous this is for the marketplace, and I've been actually warning now, this is the third week that I'm actually talking about it, because it doesn't matter what you think, okay, about Nvidia. Again, it doesn't matter. It's not about fundamentals, not about technicals, okay? It's a trade at this point. all right? And you're just pouring more gasoline into the fire. When this trade unwinds, it's going to be damaging. Now, I can't tell you if it's going to unwind this next week, okay? I'm consistent, okay? And we will hit this one, and it's going to be wild. But okay, the last point to be made about dispersion and catapult and the S&P 500, the exact same forces, okay, that drove us higher are the exact same forces that'll drive us lower. And you hear about like gamma squeezes, negative gamma squeezes. People, that's all dispersion. It's the same animal. You can call it whatever you want to call it. Those gamma squeezes, okay, are in effect a big portion of that in the dispersion trade. Nevertheless, pushing that aside, the exact same forces can actually drive us lower. So when you start looking at stuff like Nvidia, and you start looking at the option statistics, you realize 3 million contracts traded, okay, one day you're going to see this alarming number of puts trade, and people are going to start buying puts and start forcing the market down. The dispersion trade flips over. Then they start selling puts in the S&Ps and then buying puts and stuff like Nvidia. And at that point, people, it's on. It's on. As I was saying moments ago, all of this, in the one stock market, Fed speak just fell by the wayside. I don't think a lot of people realize that now the probabilities, Fed fund futures probabilities now, the first rate cut is not priced in. Look at this until June. Until June. The one I think most surprising thing about now we're not looking at cutting rates until June, and even the probabilities in June are not set in stone, right? I think if you told me that a month ago, I would have said the marketplace would have tanked, absolutely tanked, and it hasn't. It's actually held it together rather well. When I speak of holding it together, though, it's largely about Nvidia. Speaking of Nvidia, another interesting concern, on that particular front, especially in the face of all the Fed speak, is look at the advanced decline line. I mean, today, this is just a perfect example. Okay, I meant to talk about this a little bit earlier, but it's a perfect example. There are 80 stocks in the S&P 100. Okay, this is the S&P 100, but there's 80 stocks advancing today, but the market can barely keep itself higher. How is that possible? Okay, well, exactly what I was just talking about. Diversification is compromised. Okay, why is the marketplace? Oh, Nvidia is going higher. Yeah, but you know what? Big tech isn't. Big tech isn't. You got Microsoft down nominally, Apple's down 1%. Amazon's unchanged, Google's unchanged, Meta down nominally. Okay, Tesla's down nominally. Tesla doesn't even matter that much anymore. Nvidia though just isn't carrying us so much today, and I think that that's critical. Okay, last point I want to make here on this weekend update. Then we're going to get to the SPX in a little bit of a volatility check. Look, I'm not a big advocate, if you will, for VIX, but I do want to make just a very, very brief and simple point. What's interesting is markets, okay? I think you all have to agree, okay? Where are we trading right now? And you go, it's an all-time high. Yes, but volatility has not collapsed, okay? We're in an interesting situation here, okay, where volatility has definitely come in, but volatility has definitely not collapsed. This is where I say keep your hands and feet inside of the vehicle in the next week or two, okay? Because again, volatility is slightly elevated for the fact that we're sitting in an all-time high. Moreover, inside of the SPX, okay, this last week, so we're coming out of a week right now that was only a 4-day trading week. For a 4-day trading week, that's just Mr. Toad's wild ride. I mean, we tanked earlier in the week. Why? Nvidia! We actually exploded higher, okay, late in the week. Why? Nvidia! And all of this inside of 4 days. As I said, we largely ignored any of the Fed speak. And it does appear, although we're not home just yet, still 20 minutes left inside of the trading session, but it does appear we are going to, in fact, close outside the upper edge of the SPX expected move, okay? And again, we had about, let's just call it $67 of movement priced in. So $67 of movement, okay, higher or lower is priced in. We almost tagged the lower edge and we came outside. That to me is a very considerable amount of movement and considerable amount of volatility and should not necessarily be taken in stride. A little bit of a warning shot being fired across over here, especially since we're outside the expected move. Okay, what are we looking at next week? Next week is, in fact, a full trading week. And with a full trading week, what are we looking at? Okay, now they're going to compress the expected move on us. When I say compress it, well, the expected move this next week, which is now a 5-day trading week, is only $64. Okay, I think you're going to have a very, very full week. Expect every ounce of $64 or $65 of movement in here. And, frankly, that SPX expected move is not settled just yet. Markets are still open. This, when you actually pull the SPX expected move, it's got to be 15 minutes after the cash closes, exactly when I grab that expected move over there. $64 in a 5-day trading week doesn't look like enough. And I keep saying doesn't look like enough. I think you need to anticipate we're still going to see some heavy, heavy volatility in this marketplace. That this dispersion trade, if you will, is actually suppressing volatility in S&P. Why? Because traders are coming in and they're actually selling boatloads of options in the SPX, which, if you will, is actually like blanketing volatility in some respects. So think of like a blanket being thrown over volatility in the SPX. At the exact same time, the opposite is occurring, okay, in some of the big tech stocks where volatility is, well, unbridled enthusiasm. So what we have here is the makings, again, of what could turn into a very heavy volatility situation expressly inside of the SPX inside literally the next week or two. With that, that is it for this weekend's update. Again, the one stock market. My name is Don Kaufman. Thanks for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.